last 6 months, the U.S. dollar index, which tracks the dollar against 6 major other currencies, has fallen almost 5%. And that's some investors, including the 6th largest property and casualty insurance company in the world. And it's why Liberty Mutual Holding Company is diversifying away from dollar-based investments and shortening the maturity of its bond holdings. Joining us right now is the CEO of the company, is Edmund Kelly, who goes by Ted. Ted, great to have you here on Street Smart. So let's talk about what you guys are doing. You're quoted in a Bloomberg News story yesterday about you're diversifying away from the dollar, you're shortening the duration of bond holdings because of that weakening dollar. Talk to me about that strategy. Can you elaborate?
Yeah, I mean, we've had a view for quite some time that the combination of deficits and monetary easing inevitably will weaken the dollar, and it has been weakened, as you pointed out. We have obviously long-term liabilities that will increase with inflation. So to protect ourselves, we have been investing heavily in hard assets. We're a big holder of oil and gas. We're into mining and minerals. And we're just finishing wrapping up developing a wind farm in northeast Brazil.
Ted,
so we're heavily invested in hard assets.
Is the era of the dollar, the U.S. dollar, in your view, no doubt about it, on the decline here, and it's kind of over? It may just take some years to play out, but is that what's happening?
Yeah, you know, the level of decline obviously is will be open to discussion, but it was quite clear over in Davos that none of the foreigners are beginning to view the dollar as inherently weak or weakening. That the world view appears to us from talking around the world that the U.S. does not have the political courage to do what's necessary to address the problems, and the dollar will continue to weaken.
What do you think is necessary here? Are you just talking about deficit cutting?
No, well, I mean, obviously, there's the short versus longer term. We clearly have to do a much better job in reining in the entitlements. I mean, if you look at the debt level in the country compared to where we were at, say, 1946, 47, if you add the unfunded Medicare to that, we're at a debt level that is totally unsustainable over the longer haul, and we have to address that long-term issue.
What about taxes? What about taxes,
Well,
Ted?
I mean, it's sort of, we're in the political area, but you know, clearly a combination of spending and taxes, the right combination, and you know, we have to reach agreement that we have to pay more taxes, but taxes to sustain the current level of spending doesn't make any sense.
You know, Ted, we've talked a lot about inflation expectations and what that's going to mean potentially for the market. What are your inflation expectations, and how are you folks specifically changing your strategy and your allocation and your investments?
Well, we about 2 years ago we began doing through our ERM process, modeling various scenarios, and obviously inflation is the most deleterious one for us. We were less concerned about shorter-term inflation. It's you know, it's going to be very controllable, and the market seems to be responding to 1-2% inflation. However, when we take a look out towards 2014-15, which is where we have to think, we're convinced that the ingredients are in there in the cake for a return to something in the 70s and 80s. Maybe not quite that high, but definitely high single-digit inflation, 14-15.
Wow. Wait, I'm confused. You said high single-digit, then you said 14-15. Are you talking 14?
In 2014, 2015.
Okay, but you're talking like 8-9% inflation.
Yeah, that's sort of that's our working hypothesis.
Let me just ask you quickly, Ted, because we were just talking about Ben Bernanke's comment on 60 Minutes. He has said when it's time to act, the Fed can act instantly. Do you think he'll miss the curve?
Well, it's a combination of both monetary policy and fiscal policy, and you know, it's sort of, there's two ways to ease debt burdens, and the easiest way politically has always been to debase the currency, and you know, that's historically what democracies have done.
Let me ask you about the financial sector, if I may, because, you know, there's a lot of new financial restrictions coming down the pike, and I'm just curious, you've got the mortgage putback issue, that's also out there. We're not quite sure how that's going to impact financials. Do you think it's safe to have any exposure to the financial sector at this point?
Oh, yeah. I mean, they're clearly the banks are in but U.S. banks are in pretty good position. We do have a concern, though, that we're entering another credit bubble, not maybe the mortgage bubble, but some of the terms now low covenant or non-covenant loans in the LBO space do concern us. So the cheap money, the flooding the markets with cheap money is pumping up financial assets and making credit too available.
Ted, what makes you so?
We are concerned.
What you said the banks are in pretty good shape. There are some that would question that. What makes you feel so confident about the financial sector?
I think much more than the rest of the world, the U.S. banks have addressed their fundamental issues. Sure, they have some hangover problems, and it'll take a while to work through all the putback and mortgages, but the numbers we have looked at aren't at a level that would cause any significant concern. There'll be bumps in the road, but there'll be bumps, that's all.
All right, and I just want to get a little bit more on your strategy, because you guys do have to put a lot of money to work. I mean, what other markets are you looking at this point?
Well, in terms of operating markets, we are in a middle-class business, and emerging middle class, the first thing people do is buy cars. So we very like China. We're growing at 50–60% a year in China. We like Vietnam. It's got a company there. Thailand's good, and we're looking at Eastern Asia, and we're very strong. Brazil, of course, is just tremendous for us. We just last year we passed $1 billion in premium in Brazil, and we also have a big company in Venezuela.
What about Europe? I'm not hearing anything about European exposure. Are you staying away from that?
No, we're strong down in the Iberian Peninsula. We're a good company in Spain, which is obviously going through a tough time, although the company's doing fine. And we have a good company in Portugal. We're in Turkey and Poland, both of which are growing quite rapidly, but still small.
You know, I just want to quickly ask a question about bubbles, because you mentioned talking about the Fed's easy money, and a lot of people have said when that's over, you know, we could watch the bottom fall out of it here. And, of course, a lot of people talk about big bubbles over in China as well. They need to put the brakes on to deal with inflation. Are you concerned about that turn when we get there, even if we don't do it simultaneously?
Yeah, I mean, obviously any turn, if it's a very sharp turn, can, you know, like any other turn, can cause significant problems. Just the centrifugal force going around the corner, so to speak. We are concerned, but, you know, what we have seen in China has been a remarkable ability to manage the economy so far. I mean, they need to sustain, what, 8–9% growth just to absorb the people coming off the farm. So they have to, but they seem to have thus far demonstrated a good ability to manage their problems.
Ted, thank you so much. Ted Kelly, CEO of Liberty Mutual.
All right, we're going to take a quick break.